Hello. A viewer of the channel asked me to take a look at PennyMac Mortgage Investment Trust, or PMT, as the ticker symbol is. And this is a mortgage REIT, and it's a completely different investment than what we have been mostly looking at so far when we're looking at companies. And it has to be treated differently. Because the first thing that you need to understand, if in case you're not aware, is what a REIT is. It comes from the abbreviation actually means real estate investment trust, and what it is a fund that is actually investing in real estate and produces income out of that real estate. And there's basically two common methods: is either leasing offices or apartments, for example, or getting money out of income that gets produced from mortgages. And so basically payments, for example, that people are making to the trust. The nice thing about a real estate investment trust is that you do not have to own the real estate at all. And the other very nice thing about it is that by law they have to pay at least 90% of their net income back to investors. So you know that you are making a good chunk of money from the actual investment here. There is also a negative thing about those trusts. They are not tax efficient. This means that they are taxed in two sources. They are both taxed at the company level, the real estate investment trust level, and you, as you are getting dividends. So it's taxed two times for the income of the company and for your income, the dividends that you are gaining out of your investment. And the thing about examining this kind of company is that we cannot really be taking a look at the company as normally as it has its balance sheet and as it has its free cash flow and what are their liabilities and all that. Well, the balance sheet matters, but the problem is that this is a mortgage trust, which means that they are debt leveraged. They are actually providing debt. They are actually borrowing money and lending money. And so it's all about handling operations and continuing making money out of the mortgages. And so we cannot use a traditional methodology when we're examining free cash flow, for example, to necessarily discover where the company is, how the company is doing, and whether it's actually a good potential investment here. And so what we want to be doing instead, which is very, very important, is examine what is the company's dividend yield when compared to how much net income they are making and whether they can continue serving this over the years. And another important thing to keep in mind is the fact that in a high interest environment and a high inflation environment where the interests rise, and this is what happens when we have a high inflationary environment, at some point Fed has to raise interest in order to drop that inflation. What will happen here is that these kinds of discrepancies between interest rates can cause the company to shrink its cash flow earnings. And this happens because for instance, they borrow money at a lower interest rate and then the interest rate's rising, but their mortgage borrowings have been locked at the previous rate. And so this potentially could shrink their spread over here and may not allow them to keep paying their dividends. And this typically tends to happen with these kinds of mortgage rates if inflation keeps rising. Now, for this, we want to examine the dividend tab over here and see what they are doing in terms of dividend. Now, their trailing dividend over here was 11.68%, which is massive. It's a massive, very, very large amount of dividend here. And they kept paying it at many points, but in 2020, it looks like, they suspended it for a while. And the nice thing is that they have been paying it since 2010 almost, with some discrepancies where it has actually gone a little bit lower. But right now paying 0.47 in dividend payments per share. Now, the very, very interesting thing is the payout ratio, which is sitting at 130%. So it's more than the net income, which means that they have to borrow to keep making their payments if this continues. And that's not healthy at all. Now, if this keeps happening and this goes on for a while, they will have to cut dividends. There is no doubt about it. They will just have to. They won't be able to service them. And so this is something that you need to keep in mind if you want to be investing in a mortgage investment trust like this one, or any other dividend paying company, for instance, that has this very, very high payout ratio here. You want to make sure that the net income of the company is enough to sustain payments and have a fairly okay payout ratio, so that it's they don't have to borrow money. It has to at least be closer to 100 or less than 100, really, to make sure that you're doing well with your investment. And so this is what I'm worried about for this company. And I could also take a little bit of a closer look at the balance sheet, but it can be misleading again, just because this is a very, very high debt company, leveraged company, because of mortgages. And so I'm pretty sure you will see massive total liabilities here, 11.54 billion, and then total equity of 2.3 billion. That makes sense though for this kind of company. I mean, it doesn't worry me necessarily on its own. But what does worry me is the potential of not being able to pay 11%, and then all of a sudden they drop it down. And we can actually see that they haven't done it that much, but they may have to, because now inflation is rising. And so they did it over here, where they actually dropped it 50%, which means that it went down to like 5% if it was at that level. I'm not sure, because this was actually, oh wow, at some point it was 26%, the effective dividend yield. And so they dropped it down. And so this denotes that the company has been mostly paying around the level of 9% over here. So it's a little bit risky for sure. Now, the nice thing is that typically these kind of mortgages are backed by the government, so probably not a lot of credit risk here for the company. Again, you'll have to pay to take a much closer look at what kind of real estate they're actually utilizing here, to be 100% sure of that. But for this one, I would expect a company that doesn't move too much, and that makes sense. I mean, these kinds of high dividend yield companies do not move that much for the most part, although there was a massive movement over here, I guess. But typically over the years you see that there is sort of like a range here from like 17 to 27, and this is where it goes year over year pretty much, apart from this exception over here. So what would I do? I'm a little bit suspicious of this very, very high dividend vehicles, to tell you the truth. And especially, again, in this high inflationary environment, there is definitely some risk to bear in mind. Now, the nice thing about this one is it is that high that you could make a quick buck, and that would take just a few years to potentially even get 50% of your money back. That would be in almost like 4 years or 5. Now, do you trust this kind of environment? I think it's a little bit suspicious right now, and I also don't trust the payout ratio. It's high, and I'm pretty sure that if this continues, they will eventually cut dividends soon. And I'm a little bit scared of that, so I would probably stay out of this. But again, if you have a high appetite for risk, and you don't mind risking a little bit just to try and make some high dividend yield over here, maybe you can just buy a little bit, but I wouldn't go overboard personally. Maybe I would buy a little bit, but I wouldn't overdo it with PMT. And in this kind of environment, I think I would prefer an equity trust, real estate trust, just because it's easier, much easier to handle inflation. They can just raise prices, for example. They can raise rental prices, and kind of keep up with inflation. And this is where it can be pretty interesting in an inflationary environment. But mortgage REITs are a little bit of a different story. They're affected massively by interest rates. So, you'll have to acknowledge some risk here if you are willing to invest. So hopefully that helped you a little bit. I hope this video was helpful, and thanks a lot for the opportunity and the suggestion. I had a nice opportunity here to take a look at the REIT. I haven't actually taken a look at those before, for the channel. Although I have invested myself some years back, I ended up selling those just because I didn't like the inefficient taxation. Taxation. This is the thing that I don't like about REITs for the most part. But in a normal environment, and especially equity ones, I like a lot. Even mortgage ones. I mean, again, in a steady environment, in terms of inflation and interest rates, I think they perform fairly well. So thank you for watching this one. I hope you enjoyed the video. If you did, please leave a like and subscribe. And you can also find a link to our Discord channel below. We'd love to see you there. And in the meantime, take a look at this video that I made earlier about Nvidia, which seems to be crashing after reporting awesome earnings, really. So it comes to show you what the market is doing right now, right? So thank you for watching, and I'll see you soon. Bye-bye.